Welcome to Your Real Estate Source, an MLS Listings podcast series. I'm here today with my colleagues Michelle and Tom, and we're going to talk about the latest quarterly summary by Dr. Elliot Eisenberg. This is a podcast that we started with our partner economist, Dr. Elliot Eisenberg's thoughts on the second quarter of 2023. Dr. Eisenberg provides a wonderful, comprehensive look at the prior quarter with national as well as local economic and real estate data specifically for MLS listings. We encourage you to review the entire document full of interesting points by going to MLSListings.com and clicking on the Media Center link. I will be reading excerpts from the latest summary provided by Dr. Eisenberg, and then my colleagues Michelle and Tom will be adding commentary to the content, which we hope makes this information a bit more conversational and perhaps adds a bit of context to the summary. Again, please visit www.mlslistings.com, click on the Media Center link, and see the document in its entirety. Dr. Eisenberg will be joining us for an MLS Listings live event on Thursday, September 7th at 1 p.m. You can reserve your spot ahead of time by visiting the Pro Support calendar, as we will be discussing recent economic indicators and discuss what expectations we can have going into the last part of 2023. If you would like to ask questions in advance, send questions to hello@aculus.com. Also, if you are not able to join us, we will have this session on YouTube for a few weeks after the event. Let's get started. Regarding inflation, while headline inflation has fallen dramatically from as high as 9.1% in mid-2022 to around 3% now, this part of the decline has been the easiest of the inflation puzzle to fix, and the remainder will be meaningfully tougher. The reduction in inflation so far has been primarily the result of declining energy prices and related transportation costs, accompanied by the decline in price of goods as the supply chains recover and demand declined, and, finally, a dramatic slowing in food inflation. Over the last few months, we've seen declining rents and falling used car prices, and those are starting to be reflected in monthly inflation data. However, just as the increases in these areas was mostly pandemic-induced, so too have been the declines as COVID impacts fade. Unfortunately, it is the remaining inflationary pressures that are not COVID-related that the Fed must now battle, and getting inflation down to 2% will be a struggle. Most of the key measures of inflation that the Feds look at are all in the 5% range. And while they will fall over the course of the rest of the year, the challenge of bringing them down to 2% will be difficult. And the Fed has made it very clear on several occasions that they will not increase their inflationary target above 2%. As a result, it is almost guaranteed that the Fed will raise rates at the end of July and may raise them again this fall. Other central banks, with the exception of Japan and China, are similarly keeping the pressure on interest rates to quell inflation.
So, Tom, Elliot starts off his Q2 analysis, and we name the podcast this, which was not stellar but resilient, talking about the economy. And he's talking about that last 2%. And it's interesting because since he put out this document, which has been with us for a bit now, I've seen several articles in the news about that last 2%. So it's clearly an important piece of the puzzle, noting there's always some inflation, but what's it going to take to get us to where the Fed feels good about this and is not any longer raising interest rates? So anyway, it's one of those things where we've been talking a lot about pent-up demand. And so as we were trying to add some context to Dr. Elliott's write-up, the pent-up demand is what keeps apparently propping up the economy. In other words, there's some troubling signals and some of the data, but we keep spending. And then there's troubling data, and we keep spending. And even with the interest rates rising and some of that uncertainty, we're just out there with this need for, goods and services that, as Elliot describes, the saved during the pandemic and is keeping us, even though we don't make as much, because of inflation. We just want these experiences. We're going on vacations this summer, Tom, and we're buying things, is apparently what Dr. Elliot Eisenberg is saying.
Yeah, I thought it was really interesting that he also said, and because of this, the Feds may very well raise rates again when they meet in late July. And guess what? On Wednesday, July 26th, they raised rates again, just as Elliot foresaw. So, yeah, they're really trying to put the brakes on the economy. The thing that when we last talked to Elliot, he was sort of saying, he was 50-50 on, are we going to be able to go into recession, or are we going to have, the quote unquote soft landing? And
well, it'll be interesting to ask if Elliot has an update, right? Because the last time we talked to him, it was 50-50 and he was talking soft landing. But there's all sorts of information out there currently, Tom, about what is a soft landing or hard landing, or what was it that you were reading about that you can share with the audience?
Yeah, so I saw an article in the New York Times, Friday, July 28th, economic data bolster soft landing hopes. And so, according to the New York Times, it looks like a soft landing may actually be in the making. And it's still too soon to say, but they said things are looking good. So we'll definitely want to get Elliot's latest thoughts on that when we meet with him later.
Yes, definitely meeting with him on September 7th. And I want to point out, too, that in our notes, and what we were talking about, it's not like as consumers, we're out just being irresponsible or, overspending. That's not the implication. I want to kind of clarify that. Elliot notes in his document that car sales are up and some other, kind of bigger purchases. But he also cited that current federal economic policies continue to encourage spending. So there's some larger bills out there and some spending that the government is doing also that's helping this. So it's not, again, I kind of came into this being hilarious, but it's not that we're just out doing these things. It's that, there's tools that are trying to encourage this kind of behavior. And so, he's predicting that would continue on as we move into, what's an important season, particularly, which is the holiday season too. So, it'll be really good. And I'm sure in his next write-up, he will coming up with that too. I think, as we, read through the document, Tom, there were a few things that we really wanted to highlight. And this is one of them. It's like, how does the economy continue to do so well, even with all of these question marks? And we're trying to provide that for our Bay Area agents because one of the things we're always out talking about is why are median prices generally, right, as a trend in most counties that we're covering, going up, and how do we explain that? And a lot of it's supply and demand, right? We have very historically low demand, and that's keeping upward pressure on prices. So at a federal level or at a macro level, taking a step back, it's the same question. So, we talked about asking Dr. Eisenberg about inflation and maybe a little bit more about what particularly it is, because we need that explanation to talk to our clients about, is this a facade, or is this, something that's about to change quite dramatically? And so two of the questions that you and I outlined when we were talking about this, Tom, were just the core points of inflation, energy, autos, and then how that is different than our standard marketplace type items, like what we see at the grocery store or when we're out buying home goods. Because I think there's a lot of people who say that hasn't changed that much, but there are some big tickets like energy. That's a big one. And so we can talk to Elliot about core inflation and then just some of what do we see in our daily lives, to talk to him about how, that changes, and also what impacts inflation the most, right? If the 2%, as he mentions in his article, is the hardest part, what other policies are there that can be employed? I mean, they're clearly using the interest rates to really affect change. But, what are other policies, and do those have as large of an effect on real estate as the interest rates do, right? So this one particular policy affects us certainly more than most sectors. So I don't know if you have any other points to ask Dr. Eisenberg when we meet him, but as people listen to this, I think those are some really good things to keep in mind and try to get some answers about.
Yeah, I really did want to ask him about it. He says the last 2% will be a significant struggle. And, what does that really mean? And, how are, what are the policies that are really going to affect that? And what are the things that we should watch for in the real estate industry to be, aware and to help us when we're working with our clients?
Prepared, right?
Yep.
Prepared. Mm-hmm.
Yep.
Exactly.
Aculus provides several resources which are free and only available to MLS listing subscribers. The resources are spread between different apps and websites, which have now been listed on a chart highlighting the offering, what type of media it is, and where to find it, with clickable links to all 7 free offerings. Visit Aculus.com and click on Agent Resources for this Market Performance Kit, provided exclusively to MLS Listings members.
As we move into the second half of 2023, there are indications that the worst of the economic downturn may be behind us in the MLS listings area, especially with the buzz surrounding generative AI and how it is bringing interest and enthusiasm back to the Silicon Valley. Many of the labor economists believe that the tech sector has mostly right-sized and the large layoffs are mostly a thing of the past. While the IPO market is certainly not as strong as it was in 2020 and 2021, when interest rates were incredibly low, it has meaningfully improved over 2022. The stock market, and specifically the NASDAQ, have recovered about half of the losses of 2022, which should strengthen portfolios, especially for those employees with stock options. Still, the pandemic shift to work from home continues to have impacts, especially in places like the MLS listings area, where there is more acceptance of and ability to remotely work. For example, office attendance in San Jose is at the lowest in a 10-city study by Castle Systems, with Monday office presence at just 12.4% of pre-pandemic levels, compared to 19.9% for other areas. Thursday is the highest day of in-office appearances, and even then, San Jose's in-office attendance is just 44% of pre-COVID levels, below the 53.2% of other cities. The struggle between managers and employees continues, with many employers wanting a third day in the office, while employees are generally desirous of 2. Other economic headwinds are still dampening growth in the MLS listings area. The failure of Silicon Valley Bank and the resulting banking crisis hit the region hard and has limited much of the lending that startups are dependent upon. Bank regulators are likely to add many new requirements and regulations to avoid a repeat, which will undoubtedly keep some startups out of the game. With high interest rates, venture capital is harder to attract and much more expensive, and with the prospects of a recession on the horizon, investors are much more cautious. As sexy as tech is and always will be, right now, inflation and high interest rates make other, more secure options much more attractive to investors.
Dr. Eisenberg or Elliot's write-ups, Tom, are always, I consume them, just thoroughly, because I think he, the national look, the regional look, and even just the points of interest are just so helpful in understanding the, current marketplace. I mean, it's a backward-looking document, certainly, but, it helps you kind of identify trends and put some of those federal and economic type policies to what's happening around us. But there's always so much in these documents. But I thought particularly of interest was, it's the soundbite, if you will, right, for this particular Q2 response was that there are indications that the worst of the economic downturn may be behind us in the MLS listings area. He goes on to cite AI and some other investment in some of the stocks and in companies that are centered in where the real estate is happening around us. But I think that's a really bold statement. I'm so excited when he can make statements like that. We certainly cannot as part of the MLS. Our job is to get people the data that they're looking for and help identify trends and help explain some of this data and information. But we're not forward looking. So when Dr. Elliot Eisenberg makes these kinds of statements, I think that's got to be really appealing to some of our buyers and sellers that are on the fence, concerned, maybe looking to make a move, maybe looking to buy up. There's all these different scenarios. Real estate is still happening, and we see median prices increasing where, that decrease was not long nor sustained. So, we're rise of seasonality. We're seeing seasonal factors introduced back into data. I think there's a little bit of a relief to hear some of those words from Dr. Eisenberg, don't you?
Yeah, I do. I thought that was extremely insightful that he was able to, say that, yeah, maybe the worst of it is behind us. One of the things that we've been seeing, and actually, if you subscribe to Elliot's Econ 72, last night he was pointing out that the Dow Jones has been on a tear. It's had 13 days of gains, which hasn't happened. I can't remember the date, but it was like back in the 80s. So hasn't happened since last century. And in particular, the tech stocks are doing quite well. So I think Apple is trading near an all-time high, NVIDIA, because their chips are really important for AI. And then AI itself is being developed here in the Silicon Valley. So it sounds like, for those workers that have access to stock options and things like that are now perhaps a little more flush than they've been in the past, and that's always good to enable home purchases and moving up and things like that. So
yeah, I mean, there's a reason why the consumer confidence is such a big indicator and such a measure that's used in making a lot of federal, economic policy decisions, because there's something to feeling confident in order to make a housing purchase or to sell a home, which is the biggest transaction in people's lives. And so I think there's a lot to what he's saying. I mean, I know when you say AI, people start being like, what does that mean? How's that going to affect? How does that trickle down? But at the same time, he has mentioned it now in 2 of his quarterly updates, because he's citing it as not just the fact that AI is coming, but what that industry brings along with it. So you talk about NVIDIA. There's a whole sub market around it. And so that's employees, that's people feeling confident, and that's bringing a lot of buzz and a lot of talent to the Bay Area, where you need homes, you need to live somewhere. And, that's to that supply, Tom. And we highlighted it in point number 1, but I mean, it really comes down to the economics in its supply and demand. And we continue to see sustained, if not increased demand. And then we see supply that is really low. And so, if you look at the lowest number of new listings, like take Santa Clara County, for example, but I think this is happening in most counties. Santa Cruz, Monterey have fared a little better. But San Mateo, Santa Clara counties, if you look at the last 5 years, this year, routinely, we've seen month over month that it's at or lower than any time before. And that's including pandemic time. So, we've been talking about how the only 1 month that sticks out is pandemic April. And remember that was terrible. We couldn't show homes. We were all very worried. And yet that's the only time in the last 5 years we have fewer new listings come on the market that month, in the month of April. And I say this because, you can't go out and shrug your shoulders with your clients. You've got to really point to some of this to talk about what's going on in the marketplace. And so, Elliot highlights work from home. He talks about remote work. He talks about building vacancies and some other things. So there's some real interesting factors at play. Not all great news for our surrounding areas, but at the same time, these prices seem to be holding steady, if not increasing, in both common interest and single family, I might add, with common interest volatile in some places, San Mateo, for example, but seeing some pretty significant increases in Santa Clara County. So our data is really substantiating this. I guess you're like, what's the point, Michelle? Well, it's that, the data is substantiating what he's saying. And if his feelings or his positivity around AI and all of those submarkets, is true, or if he's right about that, this could be a very long, sustained, boom for the area that's much needed, right, to get back some of that. So, one of the things I wanted to point out, Tom, when we talked, you and I, about this document, we were like talking about what do we ask Elliot when we see him? And that was something we did in the last point too. But two of the things we talked about, there are two trains of thought on how the market will respond to the raising of interest rates, right? One, is there an additional demand? So prices will go up because people will be rushing out to buy homes before they possibly could be raised again. Or that the fact that people have gotten in already, right? That getting in on interest rates before they were raised again has taken place, so then demand will actually drop. And I'm just so interested to understand what he thinks will happen. Because again, we have brokers, very, very seasoned, very smart brokers in our area. And I've heard both from people saying, wait till the interest rate drops. We're just going to see a flood of demand. Others have said these prices are being held up because demand's happening now in front of interest rates being raised. I don't know if you have any thoughts on that, but certainly can't wait to talk to Dr. Eisenberg about that.
Yeah, I'm looking forward to hearing from Dr. Eisenberg exactly what he's thinking there. Another thing that he mentioned in his report was the loss of population. So he noted that we have seen a net outflow of people from the Bay Area to other parts. However, he did say that pace has slowed down. It hasn't stopped, but I think he said it's slowed down quite a bit. So we're still seeing people leave, and that has an impact, of course, but it's slowing down. So I want to question him about that as well.
Looks like we have already a list of 5, Tom, and we asked people to come to the session and ask him questions. And yeah, we have, 5 already, but I think these are really great. Hopefully this gives some of our listeners a chance to think about some of these before we go to the session, and maybe can even be more specific in answering about local real estate when we see him on September 7th.
Well, the MLS listings housing market may have been one of the hardest hit by the combined fallout of work from home, tech sector instability, and high interest rates. Recent data suggests signs of improvement. The May 2023 Black Knight Mortgage Monitor cited San Jose specifically as one of the fastest housing markets to recover, with a 1.4% seasonally adjusted single-month price gain in May of 2023 after having the largest price correction in 2022. The most recent inflation data suggests that the actions of the Fed may be working, and while at least one more rate increase is inevitable, the likelihood of an additional increase this fall is up for debate. That means that the Fed may now start considering when interest rates can come down. That means that the Fed may now start considering when interest rates can come down. Once that happens, we may see activity pick up as interest rates lock-in eases and listings improve. Dr. Eisenberg comments, we saw the fastest rise in household formation during the worst of COVID, and it is likely that we will return to more normal levels going forward. This mild weakening of demand and small increases in supply should improve activity, hopefully without the huge price spikes that we saw over the past few years.
I don't know, Tom, if it's just me, but we as a team have been thinking a lot about seasonality, and And I talk about it a lot on the road as we're in meetings and different association events, because it's a really important part of data and understanding seasonal change versus kind of like a market change. And the reason it's so important is because as Dr. Eisenberg comes in on these last pieces of his Q2 look back, he talks a lot about recovery, and he talks about how the Bay Area, real estate market recovers. And, back to your earlier discussion on outflow and migration, back to AI and how that might, bring some people in, even as people are going out. He had highlighted in earlier parts of his document still challenges remaining from banking that was centered here in the Silicon Valley. And so there's like very mixed information in his write-up, but let's focus on recovery going forward, because he talks about how this housing market was one of the hardest hit. And, the national media loves to seize on like San Francisco drops 30% and the Bay Area. But we know, and we've highlighted it previously in this podcast, that, there's a real recovery because the prices for homes are generally either increasing or staying the same. But, over time, we feel good about that. I think that, we're moving into a time of year where we traditionally see a decrease in the number of homes listed. We traditionally see a decrease in the number of homes sold. We sometimes see a little bit of a dip in prices. That would not be unusual about this time of year. And so if Elliot's correct in saying, back to point one, we're consuming, we're going on vacation, we're buying things, we're seeking out, more affordable interests, and things of that nature, then there may be less activity this summer than we've seen over the past couple of years when we didn't have the opportunity to travel, or we didn't feel as comfortable making larger purchases. And so I think that's going to be an interesting way to look at the last half of 2023 is it a seasonal change, or are we looking at real economic real estate change?
Well, I love that term, revenge travel. So I've read about how since the pandemic, people have felt cooped up, and last year, but even more this year, people are doing revenge travel and getting out there. And that's where a lot of this spending is coming from. That's maybe, leading us towards a soft landing. So yeah, I can understand why there may be less activity this summer, but you're right. Is this just a quirk of 2023, or is it something that will leak into 2024 or further? So
it's a good question. And I would also want to go back to your discussion on migration in and out of the area, because people coming in and out are not necessarily equal. In other words, to real estate agents, what matters is who's buying and selling. And so people are coming in with no intention to buy or sell real estate. Then it's not really the population in and out that matters so much. It's not the one, leaving, one coming. It's are the people leaving, the buyers and sellers, and the people coming not, looking to maybe rent, maybe only planning on staying for a bit. And so, demand is so important to this equation. So, whether these are seasonal changes or not, supply and demand, it's one side of the equation. It's a big part of what's going on here. And so is the demand to buy homes with this population change really, that's the real question. And I, put number 6, put it on the list to ask Dr. Eisenberg. So we're like, Elliot, hey, it's not 1-to-1, right? It's not apples to apples, depending on who's coming in. It's, are we attracting buyers into the market? Is the AI, right. Is the banking, is that attracting the people we need, which are transactional?
Right. So the people leaving are the people leaving renters, because then that's different than somebody selling their home and leaving. So
reading the transaction.
Great question.
Oh, I'm glad you think so, because I have one more in our notes. And that's to talk to Dr. Eisenberg about, Elliot. I mean, I go through this thing where, do you call him Dr. Eisenberg? It makes, he earned it, but we know him as Elliot, any case. the reaction to interest rates, I know that will be a hot topic when we see him on September 7th. That's a Thursday, 1 o'clock. He was right about predicting there would be a small increase at this meeting, and what happened, and so he saw that coming. There were a lot of folks who thought it would be that it would happen, and it did. I guess the question I have for him, though, is the reaction to that, or some of the expectations that might be set to this. And, people already saying, hey, if it happens again, this is going to have some really devastating effects, because we know anecdotally our brokers and agents have told us that people are coming to terms with these higher interest rates. But at the same time, every time you raise them, it gets harder. It gets harder for people in terms of real money. And so if there are potential buyers and sellers concerned about an additional raising a rate, that can have a real effect as we go into what is oftentimes a fall bounce. That's what we like to call it. We see a little bit more transaction. We see a little bit of a bump in price a lot of times, or sale to list price ratio, meaning competitiveness. And so the question is this going to make people worried about another one? And then does it draw people in to hurry up? If you're going to buy something, buy it now before it could get raised again. Or again, does that just make people sit on the sidelines and we don't see that increase in demand? So, boy, it sounds like we have a lot to talk to Elliot about.
We do.
He couldn't be coming at a better time, Tom. I mean, maybe we should have a private session and then a public session so we don't overwhelm him with questions, because I know that our agents come out just firing questions. Everybody has a lot that they want to know about. And as we've covered, some of the industry changes, we've talked about AI, we've talked about interest rates, we've talked about economic policy, and yet that's just scratching the surface. This document was chock full of lots of different points that you can share with your clients, that our listeners can share with their clients about. And so we really encourage you to go read the document in its entirety. And we, of course, encourage everybody to join us on September 7th at 1 o'clock to talk to Elliot about this document and any other questions. And who knows in the next, coming weeks here, what's going to pop up. So really looking forward to that. We hope everybody found this helpful. Tom, thanks again.
You bet. We really enjoyed the conversation.
Don't miss out on the Aculist quarterly market reports. The Aculist Price Segmentation Report contains important key performance indicators, with homes sold in different price ranges over the past 2 years. Paired with the price per square foot table, this report highlights sales trends and sold home values, a perfect fit for clients who are interested in learning more about the availability of homes at a certain price point and where there is the most competition for those homes. If you are interested in providing your clients with a fresh take on external real estate factors, the Aculist Quarterly Newsletter Report provides an overview of the housing market as explained by our partner economist, Dr. Elliot Eisenberg. This report provides notes on the overall economy as well as regional insights for clients who may want a broader look at the overall real estate market in the Bay Area and beyond. With Q2 data now available, these quarterly reports provide maximum value for you and your client. To get these reports, just click on Aculist Market Reports from the Pro homepage and search by the county you are looking for. Arm yourself with the most up-to-date, accurate, and relevant information to educate your clients, prospective buyers, and sellers with exclusive Aculist data. Let Aculist help you be the market expert.
This is a podcast designed to provide you with talking points to share with your clients. Again, you can find the document in its entirety on MLSListings.com under the Media Center tab. If you find this podcast helpful, please let us know. We welcome your feedback. Email hello@aculist.com with suggestions. This podcast is not done, though. Please stay tuned for summary points made by Dr. Eisenberg regarding the Bay Area real estate market.
Year over year, single-family homes priced across the region declined during the second quarter of 2023, with the largest percentage decline in San Benito County, where prices decreased 10.2% to a median home price of $769,500, the lowest in the region. The smallest year-over-year percentage decline was in Monterey County, where prices dipped 1.9% to $858,000. Home prices remained the highest in San Mateo County, where the median price was $1,900,000 and declined 9.6% compared to the second quarter of 2022. Prices in Santa Clara County declined 5.7% to $1,775,000, while prices in Santa Cruz County decreased 5.4% to $1,277,500. The townhome and condo market generally saw year-over-year median price declines, although common interest prices in Monterey County increased by 3.4% to $659,000. Prices in San Benito and San Mateo counties declined about 10% to $540,000 and $918,000 respectively. Prices in Santa Cruz County declined 8.6% to $788,500, and prices in Santa Clara County remained the highest at $980,000, a 5.3% decline over last year. Year-over-year closed sales for all types of property declined by about 28%, and the combination of lower prices and declining sales pushed overall sales volume across the region down by about 30%. Overall, new listings of both single-family and common interest properties were down about 28% across the region compared to last year, with the largest percentage drop in Santa Clara County, where new listings declined by about a third. There is less than a month's supply of single-family homes in Santa Clara County, a 1.4-month supply in San Mateo County, and a 2.5-month supply in Santa Cruz, Monterey, and San Benito counties. On the common interest side, there is less than a month's supply of inventory in Santa Clara County, 1.4 to 1.8 months in Monterey, San Benito, and San Mateo counties, and 2 months in Santa Cruz County. The percentage of listing price received at sale compared to last year declined across the region but remains strong. Single-family homes still sell for more than their original listing price across the region, with the highest premium in Santa Clara County, where homes are generally able to sell for 105% of original listing price.